How is everybody doing out there? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So today I wanted to talk about Warren Buffett. Obviously, a lot of news around Warren with him stepping down as CEO of Berkshire Hathaway at the end of the year. And I came across a great article in the Wall Street Journal that I wanted to share with everybody. And this is called Why There Will Never Be Another Warren Buffett. 3 things combined to make Buffett the stock intoxicated man, an unrivaled investor. So this was written by Jason Zweig, who's a great columnist over at the Wall Street Journal. Read, many of his pieces over, feels like forever, over like 20 something years. But he wrote this very interesting piece here about Warren. And so let's read through this here a little bit. And the 3 things that he feels adds up to why there will never be another Warren Buffett. So there's only one Warren Buffett and there will never be another. On May 3rd, Buffett announced that he will step down as chief executive of Berkshire Hathaway, the conglomerate he has built into one of the most successful investments in history. There are 3 reasons why he has no equal and never will: the person, the period, and the package. So let's start with the person. Buffett is not only brilliant, but he has also spent nearly his entire long lifetime obsessed with the stock market, especially in his early years as an investor. His unparalleled success depended on an unbearable sacrifice, foregoing a normal social and family life. A later writer called the great 17th century philosopher Baruch Spinoza the God-intoxicated man. Buffett is the stock-intoxicated man. Ever since 1942, when he bought his first stock at age 11, he has devoured information about companies, reading corporate reports the way most people listen to music. As a young investment manager, Buffett would wander through his house with his nose in a corporate annual report, practically bumping into the furniture, oblivious to the comings and goings of family and friends. While his kids played at an amusement park, he would sit on a bench and read financial statements. Buffett was there physically, but mentally and emotionally, he was off in a world of his own, fixated on carry loss forwards and amortization schedules. Imagine being that obsessed. Imagine enjoying it. Now imagine enjoying it almost every waking moment ever since Harry Truman was in the White House. That's how unusual Buffett is. Expertise is rooted in pattern recognition, and Buffett has seen every conceivable pattern. Given what I know about his work habits, I estimate conservatively, I believe that Buffett has read more than 100,000 financial statements in his more than 7-decade career, and his memory is almost supernatural. Years ago, winding up a phone interview with Buffett, I mentioned a book I was reading. He exclaimed that he had also read it more than a half century earlier. As he began describing a passage, I grabbed the book, found the page, and realized to my astonishment that Buffett recalled almost every sentence verbatim. His unparalleled exposure to financial information combined with his prodigious memory made Buffett into a human form of artificial intelligence. He could answer almost any query out of his own internal database. That has given him an unparalleled ability to identify the kernel of significance in any new bit of information during a durable advantage over other investors. Now that AI is universally available, a person with Buffett's massive command of data won't even have an advantage in the future. Then there's the period, the time over which Buffett had exercised his investment prowess. As he had said many times, he won the ovarian lottery by being born when and where he was. Had Buffett been born in Omaha in, say, 1880 instead of 1930, he would have had to invest in livestock instead of stocks. Had he been born in 1930 in Omsk instead of Omaha, he wouldn't have owned railroads. He probably would have had worked on the Trans-Siberian Railway. And Buffett happened to come of age just in a time to study under Benjamin Graham, the pioneer of security analysis and one of the greatest investors of the past century. Buffett also began his career before trillions of dollars had poured into the stock market from index funds and other giant institutional investors. He built his phenomenal early track record by fishing where no one else had even looked to catch anything. He fed on the tiniest plankton of the stock market. He bet big on the small fry. At various points, his investment partnerships had 21% of their total assets in Dempster Mill Manufacturing, a maker of agricultural equipment based on Beatrice, Nebraska, and 35% in Sanborn Map, a New York-based chartography company whose investment portfolio alone was worth more than its stock price. Sometimes it took him years to build a position in stocks that almost never traded. From 1957 through 1968, such obscure bets helped produce an average return of 25.3% annually, compared with 10.5% for the S&P 500. Buffett was able to outperform the market by stepping outside the market as most other professional investors then defined it. A study of the returns of stock mutual funds from 1945 through 1964 compared them to the Standard & Poor's Composite, as the S&P 500 was then known, and found that none performed significantly better than would be expected from mere random chance. Buffett, on the other hand, brought almost nothing that was part of a major market index like the Dow Jones Industrial Average or the Standard & Poor's Composite. And Buffett didn't merely succeed, he succeeded over one of the longest career spans any investor has ever had. He took over Berkshire, a tattered manufacturer of textiles, in 1965. By the end of last year, Buffett had racked up an annualized average return of 19.9%, compared with 10.4% for the S&P 500. Almost anyone with a reasonable amount of luck can beat the market over a year, so far as I know. No one in history has beaten the market by so wide a margin over a period of 6 decades, because only Buffett has combined extraordinary investment skill with such extraordinary longevity. Finally, Buffett placed his investments in a package like none other. Berkshire Hathaway operates as a publicly traded holding company, a receptacle for whatever he has thought worth owning. Other publicly traded stocks, treasury bonds, private companies. At one point, it was even one of the world's largest holders of silver. Now it holds more than $330 billion in cash. Berkshire isn't a hedge fund. It's not a mutual fund, exchange-traded fund, or any other conventional investment vehicle. By design, it charges no management fees that would subtract from its returns, and no performance incentive fees that would encourage excessive risk-taking in pursuit of a big payday. Most investment funds operate under a curse that economists call procyclicality. After a fund racks up a streak of good returns, investors throw money at the fund, forcing its managers to put the new cash to work in a market that is likely becoming overpriced. That hinders future performance. Then, when returns falter in a falling market, investors yank their money out, forcing the fund managers to sell just as bargains are becoming abundant. The fund's own investors make its performance worse, intensifying the market's ups and downs. Berkshire's only cash flows, however, are internal. Money comes in from or goes out to the assets it owns. Cash can't come pouring in from new investors or get yanked out by fleeing investors at the worst possible times, because you can invest in Berkshire only by purchasing shares from someone else in the secondary market. This package has given Buffett a structural advantage that has enabled him to pursue opportunities wherever and whenever he has perceived them. That's a luxury almost no other professional investor has or ever wants. So long as most fund managers can earn a lavish living for underperforming the market, the real risk for them will be trying anything different. Pigs will sprout feathers before anybody has the daring to try truly emulating Warren Buffett. So again, a phenomenal article. And for people that really don't know that much about Berkshire Hathaway or how it works, or what Buffett has done over the years, I think that this article, while albeit very short, is very enlightening. It gives you a great purview of what's going on. So is the man himself, the time period he was born into, and then ultimately the investment vehicle that he created in Berkshire Hathaway that enabled him to have the massive amount of success that he had. Now, I will say a couple of things. While Warren is certainly a genius, and he is certainly one of the greatest investors of all time, I would put a little caveat here. Once you get to a certain spot in life, once you get to a point where you're worth X number of billions of dollars, and you kind of have holdings in all the major players on Wall Street. At one point in time, he had. He still has major holdings in a number of the big banks, but he had major holdings in Citibank and Wells Fargo and Bank of America, JP Morgan, owned 40% of Moody's. When you have that kind of position and you have access to every conceivable major player on Wall Street and in the finance world, I think a lot of times you get a tendency to have a lot of, you get a lot of insider information to kind of, give you a hint on what maybe some of the things that might be happening or might be coming down the pike. That's not to say I'm not saying that Warren traded on insider information. I'm just saying that he has undoubtedly he had access to information a lot of other people didn't have. Now again, that's later on. I don't think that was definitely not at the beginning. I mean, at the beginning, he was like you said, buried in annual reports and amortization schedules and cash flow statements and everything else, trying to pick really good investments. So, and he picked really good investments. He was really good at it. I'm just saying that, hey, you get to the top of the mountain, and there's certain perks that come along with being at the top of the mountain. That's all I'm saying. But I think that there's a lot to this. There are a lot of things that would have to go right for someone else to try to emulate the performance and the success that Warren has achieved in his life over such a long period of time. I mean, 6 decades. I mean, it's just an amazing stretch of investment success. I mean, and it's hard to believe that someone else will come along and have another 60-year run like this. It's just incredible. So, and then with that, I want to leave you guys with this. So this is from Emily McCormick over at Bank Director. She wrote a little blog post here basically called Berkshire Hathaway's Tricky Transition. So in it, she says Warren Buffett at 94 announced he will step down as CEO at the end of the year, handing the reins to Greg Abel. Abel, 62, who joined the company in 2008, has run its non-insurance operations since 2018. He was publicly named Buffett's successor in 2021. While the timing appeared to be news to Berkshire Hathaway's board, directors voted the next day in favor of Abel as their new CEO. In 2014, Buffett wrote about the importance of choosing the right CEO in his annual letter to shareholders. Managing Berkshire is primarily a job of capital allocation, coupled with the selection of retention of outstanding managers to captain our operating subsidiaries. He wrote, that would require a rational, calm, and decisive individual who has a broad understanding of business and good insights into human behavior. It's important as well that he know his limits. He also said that CEO should be a company insider who would put shareholders first. A Berkshire CEO must be all in for the company, not for himself. Buffett, who has been a controlling shareholder of Berkshire Hathaway since 1965, plans to hang on to his shares, a substantial 37.9% of the company, holdings that are primarily higher priced, Class A stock. He will also remain chairman. It can be a tricky balance for a new CEO to lead a company alongside their predecessor. For Abel, he'll report to a board that includes the world's most famous investor, one who successfully run Berkshire Hathaway for 6 decades. So yes, very interesting thing there. I think that, Greg Abel certainly has his work cut out for him, and we will all be watching to see how successful he is in the future and how this all works out. But I hope that people found this very interesting, a little bit of insight into Warren Buffett, his life, maybe the things that made him successful throughout the tenures of 6 amazing decades. But with that, I will wrap up and basically say, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone has an awesome day out there, and I will see everyone again real soon. Thanks a lot.